in a period of time, can you ignore it? Sure. Can we ignore all the stuff that's going on in this world right now? Maybe. But the geopolitical risk and the financial risks that are still in the system, I think are being underappreciated in the markets. Maybe we'll get some type of clarity over the next week or so, but I don't expect that. So I expect a lot of volatility, a lot of stock picking that's going to matter. Again, when the market has these big sell-offs, especially in the Russell, a lot of small cap companies get thrown out. Those are the ones you want to look at and buy. And so I think there's opportunities again on both sides.
Welcome to the Monday version of the On the Tape podcast. I am Guy Adami. I'm always joined by Elizabeth Young-Thomas of SoFi. EYT, how are you?
I am very well. Another big Packers win.
Another big last-second field goal. McManus, perfect. We will get into that, but it's great seeing you. And we have the honor and privilege of Danny Moses joining us today. Danny, how are you?
I like this Monday stuff. I like starting off the week, seeing your guys' faces. So,
you talk about Super Bowl week and those types of things. In terms of earnings, one would think that this is about as good as it gets. We have a bevy of very important companies reporting with an S&P 500 effectively at all-time highs. So, gauge to me how important you think this week is and through the lens of earnings.
Yeah, well, I always talk about Super Bowl being Fed meetings for me. I get 8 of those per year, so I'm a little spoiled. But this is the busiest week. I think last week we had something like 112 or 115 companies. This week we've got, 170 companies reporting, and a lot of these big tech names, which I continue to believe are very important for sentiment in the market. So they need to at least meet, if not beat, expectations. We still could have the reaction that we've had for the last couple quarters, where if they don't beat by a huge margin, the stock gets punished a little bit. But I think as long as they sort of hold up, sentiment stays intact. But what we've seen, I mean, the market obviously just opened today. We're up marginally in all 3 big indices. What we've seen for the last couple weeks is this pause in the uptrend. So sort of indecisive. I think a lot of it has to do with the fact that we never got the volatility that we normally get in an election season. Not that we're necessarily going to get it this week, but that equities have seen such a big run up when they normally wouldn't, that maybe we pulled some of that forward and now there's this pause. Let's just wait until we get past the next hump. And that's not to say that earnings will take a back seat, but I do think this earnings season is up against a lot of a news cycle and a lot of different headlines where it's just not going to be quite as much of a newsmaker as it usually is.
Yeah, and let's talk about that, Danny, because I saw a story out of Bloomberg. I'll read. Companies in the S&P 500 are beating earnings estimates at the lowest rate in nearly 2 years, a trend that could point to declines for the U.S. stock benchmark. We'll see if that plays out. But, as EYT said, we had 111 companies last week, 75% reported better than expected, which, by the way, if you watch or listen to or read John Butter's work, that suggests it's probably right in line. This week, the big ones that everybody's going to look at: Alphabet, Google, Facebook, Microsoft on Wednesday, Amazon, and Apple on Thursday. So again, in terms of just the earnings picture, anything stand out to you?
I think it's a hold your breath moment ahead of the election and the Fed next week. So it's probably a great opportunity to actually dig into the fundamentals of the companies when they report, whether there's an overreaction to the downside or to the upside. I think people aren't going to be paying as much attention because the macro, to Liz's point, I think is overweighing micro here. But you guys have obviously, we're going to get into this and talk about rates and kind of where they're headed. That is the bigger backdrop to me, and we'll get into that. But earnings have been fine, but we're starting to look at kind of turning the calendar, not just to Q4, but 2025. And so I think it's as much about guidance and talking about 2025 as it is on what the company's going to be, reporting right now this week.
Yeah, listen, no question about it. We have some other fascinating companies this week, just based on what's been going on. McDonald's is this week, and obviously they were in the news last week. The stock, to me, actually traded remarkably well given the news. Starbucks has obviously been in the news. That's this week as well. For me, Danny, Visa and MasterCard. Now you say, why are they important? Well, obviously, transaction processing companies, they don't take credit risk. But, what we saw with American Express suggests, at least on the margins, that things are deteriorating a little bit in terms of delinquency rates. So can you glean anything from MasterCard and Visa, do you think, or are they just completely out of the scope of companies that take credit risk and therefore should not be lumped in with a name like AXP?
Yeah, they're out of credit risk. They're more about spending and retail sales, which you've seen have been strong. So that'll be a read kind of into that. The backdrop on those are obviously government intervention, discover a Cap One deal, creating another payment network as competition potentially. So that's actually driving those stocks more right now. It's pretty predictable, I think, what the numbers will be for Visa and MasterCard. So
You mentioned, Elizabeth, your Super Bowl. That's obviously around Fed meetings, but we have some economic data that you're always very interested in. We get the JOLTS number on Tuesday, non-farm payroll this Friday, November 1st, and GDP for the third quarter on Wednesday. So all of them in and of themselves, I think, are important. And we're going to talk about yields in a second, but are you focused on those at all? I think JOLTS to me is the most interesting one.
Yeah, jolts have had the propensity to move markets for the last few reports. And we had that one scare where jolts came down quite a bit. Now, what we're talking about here is job openings, so the number of jobs that are open for unemployed workers to fill. And when we had that period where the labor market was so tight, it was because there were so many jobs open, not enough butts to fill the seats. Now we're almost in balance. And we had that little scare where job openings came down considerably. So they surprised to the downside, but now we've had a reading where jolts were bigger than usual. And it's sort of back and forth. I do think that the market is still much more focused on labor than it is on inflation. So if we get a big surprise in jolts, particularly if jolts come in weaker than expected, I think it would send the market into a I don't know what to do with this data sort of state. So that is going to be interesting. Consumer confidence continues to come in decent. We had Michigan last week that came in decent. So I don't think that's going to be a big mover this week. And then GDP, I think, will be important, but we've been tracking at a pretty healthy pace. I would be surprised if GDP shocked anybody. And then obviously the labor data that comes in on Friday will be a big one as well. Again, much like jolts, we had that one report where the unemployment rate went up much more than expected, but then since then we've had some pretty healthy reports. So if things continue to come in healthy or even hotter than expected, you might see a big movement in rate expectations. You probably see more volatility in yields. We've obviously had this big run up in yields, which I know we're going to get into in a little bit, but the volatility in yields is not likely to abate, in my opinion, on this week's data.
Yeah, I agree with that. I mean, it's the yield story is in and of itself, I think, something entirely different. As you said, we will talk about that in just a few minutes. But Danny, anything this week that sort of sticks out to you? I don't know how important GDP is. Obviously, maybe ahead of this election next week, it'll garner some headlines on either side of the aisle. But thoughts on some of the economic data this week?
yeah, it's not just in the US. Chinese data is coming out. By the way, they did another intervention last night where they opened up repo facility. That's a whole nother issue. You got the budget in the UK. Again, there are some stock specific things that are impacted there. But remember what they did 2 years ago that caused all this stir. So something to watch there as far as the UK. We're going to talk about Japan, obviously. The news there, the BOJ is also meeting this week. So there's lots of stuff going on. But bring it back to the US again. I don't think any of the data really matters this week. It'll matter in the future when people look back to it. But I just think that the election and the Fed next week are just the overriding factor for what could be a 2, 3, 4 year trade versus a monthly report on a blip on a employment data. But I do think that the trend that we're seeing right now, the economy still has its strong footing here. We're seeing less and less built-in rate cuts. We're now down, I think, total from now to the end of next year, I think maybe 4 or 5. At one point, we were 8 cuts or 200 basis points from here. So things are changing. And the one thing I'll say is, point you just made, I know we're going to get into yields here, is on inflation. And things are pointing towards inflation stop gradually going down and potentially to start rising. And that's the whole thing that the market is absolutely not prepared for, in my opinion.
Yeah, let's talk about yields, Elizabeth, because as we're sitting here, again, we've talked about this a number of times. Right as the Fed cut interest rates by 50 basis points in the middle of September, yields have basically done nothing but go straight up in the terms of 10-year. I think we probably bottomed out around 360 or so. We've gotten up to close to 427, but the move has been significant. And again, it really comes down to how you interpret all this stuff. I think the naysayer like myself will say the bond market is going down, yields are going higher for some bad reasons, not least of which all the issuance that has to come, the possible reacceleration of inflation, all different types of things. I think the optimist will say, you know what, Guy, you're missing it. It's because the economy's on stable footing and yields are going higher for the right reasons. So just thoughts about this bond move, because clearly the market hasn't cared whatsoever.
Well, I think the last time Danny was on with us on a Monday, we talked about this and we had what I would call relationship problems, where you've got stocks up, yields up, VIX up. That cannot persist into perpetuity. This morning, we actually have the 10-year yield down a little bit. It's back down to 424 after almost kissing 430 at some point. So there's still volatility in the yield market. So I think still at this point, yields have risen because the economic data has come in hotter and because there's been these surprises. But there's the saying, trees can't grow to the sky. So if things continue this way, we continue to get hot economic surprises, at some point the inflation conversation comes back into play and people start to get concerned about that. I think 425 on the 10-year was a mental threshold where stocks at least took a pause and said, how much more of this can we withstand? Or at least let's wait and see what happens until after the election, maybe until after this jobs report, maybe until after the big bulk of earnings season to really try to find out if we can get a next leg higher. I don't know where the next threshold is in yields. I'm sure there's an answer to that from a technical perspective. I'm no technician, but I don't know where the next threshold is. I just know that the chatter about 5% in 10-year yields has picked up. That seems like a far cry from here. But if we start to approach 5%, I think equities will see a decent amount of pain between now and then.
Yeah, I agree with that. And it's interesting. We had Katie Stockton on Fast Money last week, early last week, and her work suggested that the TLT, for the time being at least, was probably done going down. Maybe you'd get a bounce in the TLT, which suggests that maybe this 4.25 level is a short term top, and maybe we sort of back and fill a bit. That's from the technical levels. From the fundamental side of things, Danny, you have Paul Tudor Jones, who was on, I think, Squawk Box last week talking about the bond market. He's short treasuries. And then you have Stan Druckenmiller, who is now 20% of his portfolio is short bonds, which is a significant position without question. Is obviously a pretty large bet. And I think it speaks volumes as to what he sees is going on. And I think both of them line up on the same type of reasons why. Regardless of the person who wins this election, it's probably going to be somewhat inflationary, and all these issuances that are coming up, and obviously the debt problem that we've talked about ad nauseum for quite some time, which, by the way, the market doesn't seem to care about. So, we went from a bull steepening in terms of the yield curve to a bear steepening, both, by the way, indicating bull or bear for the bond market. I want to be clear, it really has nothing to do with the equity market. But as Elizabeth has said numerous times, it's not the inversion that gets you, it's the re-steepening, and it's re-steepening with 10-year yields going higher. So that was a lot, I know, but thoughts on that?
So we are approaching the 1-year anniversary of Janet Yellen's Jedi mind trick when the quarterly refunding announcement kind of changed the tenor to shorter end of the curve issuances and maybe a little bit less overall. So that's this Wednesday, by the way. So let's be clear. So that was a huge event. And back then, a year ago, the 10-year yields were just under 4.9%. The 2-year was just over 5%. So just put that in context. I think the direction of the 10-year yields is a combination of both that can actually kind of fulfill its destiny. What do I mean? I think right here it's trading not in danger zone. I think we've talked about the number that Liz just mentioned towards 5% is kind of the point of no return. But as you move up and you transition from economic growth to potential issuances or term premiums that are necessary to get the yields to justify the risk, that's when everything kind of looks back and says, okay, that's why yields went up a little bit on economic growth. And now it's going up a little bit more on credit risk. But one other thing that's being blended in here, which is I know we're going to talk about, I think is overlooked, is oil. I mean, oil is a direct tax on the consumer. We woke up this weekend, or we woke up this week after the weekend. Thankfully, things have seemed calmed a little bit in the Middle East. But that oil coming down obviously is deflationary. It's good for the consumer. So I think lost kind of in all this stuff going on is oil here, which I know we can get into, but I think that's something that we need to talk about for
Well,
sure.
let's talk about that, Elizabeth, because we're sitting here right now. Oil futures are down about 6% or thereabouts in terms of dollars, just to put it in context. About a $4 move in WTI, which you don't see all that often. I mean, this probably happens maybe a handful of times a year, obviously on the back of what Danny just talked about. But it suggests a couple different things. Either you have an economies globally that are slowing down, or maybe this is just sort of too much risk premium in oil in the first place. But obviously something's going on. People will look at this and say it creates a bit of a tailwind for the consumer, I guess. But I'm not certain that is effectively the case because, as you know, crude prices can go down very quickly. Gas prices, not as much. And those things tend to be pretty sticky. So Thoughts on the importance of the crude market?
Well, I think it's very important when we look at news cycles, but last week we had a little bit of a de-escalation, so we saw a big drop in oil prices on that. Again, last time Danny was here, he talked about the relationship between oil prices and gold prices. So if you've got commodity prices in oil coming down, gold prices going up, that should be good for gold miners. That had been the case, and that was the case last week as well. So when we look at oil prices, this is one of those elements that just doesn't quite jive with the current narrative. So the current narrative is that we've got this broadening out in sectors. You've got cyclical sectors coming in to carry some of the weight that the Mag 7 or tech stocks are no longer carrying from a return perspective, and perhaps even starting to carry it from an earnings perspective as those companies pull back from being such a big share of S&P earnings. But then you've got oil prices that just can't quite come above a certain level. This I would actually put this in the same category as small caps, right? Small caps can't quite get to new highs. So that and something like oil, which should be a very cyclically sensitive price point, should be something that if cyclicality is that strong, demand is that strong globally, and if China is stimulating, for example, as well, oil prices should be moving higher and they're not. So I think in the short term, it's going to be read as this is good for the consumer. The consumer has more money to spend. It's going to be good for holiday shopping and retail sales because we're not getting pinched on some of those necessary items, which we've talked about many times. But if we look back on this period, and I know I talk about this all the time, I always ask myself, 6 months from now, when I look back at this data point, am I going to wish I paid more attention? Or am I going to talk about the fact that the market wasn't paying attention to this? And oil prices could be one of those early indicators that cyclicality is actually not as healthy as we think it is.
Yeah, I agree with you. I think it's absolutely important to watch it because it doesn't just speak to obviously the geopolitical things. I think it speaks to the health of not only the U.S. economy, which is again is the largest economy in the world, but globally what's going on. And Danny mentioned earlier, China continues to struggle, and they obviously continue to throw money at what is a mounting problem, and one that I don't think necessarily throwing money at is going to fix, but we will find out. Elizabeth, I'm going to keep you out of this conversation because we don't get single stocky with you. But I think one of the big stories over the last, forget about few weeks, last few years, is in the form of Boeing. Now, this was a company that I think in February of 2019, Danny, was a $425 or so stock, probably had a market cap north or right around 300 or so billion dollars. As we're sitting here today, $152 stock with a market cap of less than $100 billion now. $19 billion secondary offering, one of the largest ever by a public company. 90 million shares basically ish that they issued, if you think about it, or they sold, I should say. Maybe they'll 21 or 22 billion if it's oversubscribed, but obviously a big share offering and a lot of proceeds going into their coffers, which is important to shore up a balance sheet, which is challenged in a word. They obviously have Moody's on their back, S&P, some of the rating agencies. Clearly, that's been a story. I only bring up Boeing, Danny. How important is it, do you think, to the sentiment of the market? More importantly, what does the government have to do, if anything, at some point? Because Boeing is such an important company for the United States. Thoughts on that?
Well, they have an audience of three, which I've talked about before, which are the three rating agencies. Because if they get downgraded to junk, obviously the interest payments start to increase. So they couldn't have that. Just a week ago, they said they're going to raise $25 billion in equity and debt over the next 3 years. Now it's $19 billion over the next few days. So we can see where this thing is headed. And it's a very important company from an employment perspective, talking about selling off their defense business. So they're throwing everything they can at the wall, I believe, to keep the rating agencies at bay while they figure it out. I've said all along, I think there's an implied government guarantee in their business, period, which is why the debt certainly trades a little bit higher yield than single A, but it does not trade, I believe, near junk status. But everything on that company rates junk in terms of coverage, EBITDA, cash to debt, anything you want to come to. So I actually would own the preferreds. I would own the debt, but I would not be comfortable owning the equity. I will say that obviously this deal was obviously wall crossed last week. And if you look at the stock, when they first floated this idea, we went to the kind of low 140s. So Guy, I don't think they've priced it yet, but my guess is it's in the mid to high 140s level, kind of somewhere. I'm not looking right now where the stock is trading at this moment, but it should survive. But let's look, they were down to under 10 billion in cash left, right? And north of what, 55 billion in debt, 60 billion in debt. So this company needs to obviously get through this quote cycle between the crashes pre-COVID, then COVID, et cetera. Obviously, this company has faced a lot of challenges, but then they had a lot of self-induced pain that they, did to themselves. Self-inflicted pain that they brought onto themselves. So I look at this thing as a government-sponsored entity, to be honest with you at this point. So nothing's going to happen to it, but I would not own the equity.
Elizabeth, in January of this year, dollar yen traded down to about 140 or thereabouts. By the way, that's having been about north of 150 around Thanksgiving of last year. It proceeded to then go from 140, I think we got to about 161 and change in early July, only to see it plummet all the way down to about, I think, 138 and a half, 139 in early September. And as we're sitting here now, either side of 153. So, fourth largest economy in the world, a currency that's trading like a developed market currency. Obviously, there's a lot going on in terms of their bond market. And I know Danny has thoughts in some of the things that are going on and the government side of things there. But August 5th, that Monday, was basically, I think, predicated or set in motion by a pretty precipitous move in bond yields and the move in dollar yen. And then we saw what happened here in the United States. But the volatility has not gone away in dollar yen, nor has it gone away in their bond market. Thoughts about the importance of this, or has the market completely looked past what's going on in Japan?
I think a lot of other things have taken center stage, so it has looked past it to some degree, but it is something that we should watch. And in fact, it is the last tweet that I sent on Friday. There's a chart out there about how bullish positioning in the yen had really picked up. And you can see in the chart, it shades it green. But now the long positioning as the yen has depreciated has really fallen down. And you can also look at the chart just before that fateful August 5th day, we had long positioning in yen at a low. So if we continue to drop, if the yen continues to depreciate, now I don't know that people would re-risk the same way that they were exposed before August 5th, but this is something that crossed over a threshold. Obviously, investors have sort of given up on that long position in yen. And I think it's worth watching. And this is something that over the long term period, over let's say the last 2 years, I think this has been a part of the story of why gold has risen so much as well. Just the expectation of currency volatility around the globe and the fact that central banks don't have as much control as they did before on currency volatility in particular, and the Bank of Japan being the beginning of that problem. So I think it's something to watch, and this is another reason why I still think the gold trade is a good place to be.
Yeah, I agree with that 100%. And, obviously, we don't have them here in the United States, although who knows what happens in the next decade or so. But there's something called snap elections, Danny, and we have seen one in Japan. So, thoughts on some of the unrest politically in terms of the Bank of Japan, in terms of the government overall, and what it potentially could mean, if anything, because again, as we're sitting here, our S&P 500 doesn't seem to care, completely impervious.
So their LDP, as they call it, lost a majority for the first time in 15 years. And Guy, before we came on today, I was thinking to myself, what should the theme be for this entire week? It's stand and deliver, both for earnings. And then the comment from Edward James Olmos, who played Escalante, says a negative times a negative equals a positive. Well, when you look at Japan, they have basically no type of majority in government. They not controlling inflation potentially. And now potentially they're not going to raise rates. So we'll deal with that later. So there's two negatives. What happens? Their markets go up 2% overnight, right? So I'm not going to try to predict that, but it does have implications on the macro community. It does have implication on global rates. It does have implications on gold as far as what Liz is talking about. I think people woke up on August 5th to the strengthening of the yen and the unwind of the carry trade, what that can mean. We're kind of in this 152, 155 zone, kind of no man's land there, I guess you would say right now. But listen, they have BOJ meeting this week. They have inflation, unemployment data this week in Japan. And so there's going to be a lot of news there. Again, might be overshadowed because everyone's focused on what's happening here in the U.S., right? We're not really looking. But again, these are things that you're going to have to pay attention to watch. And keep in mind, they import, obviously, energy. When the yen was weakening and oil was in the mid 80s, it was very treacherous for them. Oil's back below 70 here. So the yen weakening is not as impactful to their economy as it was when oil was strong. So a lot of moving parts here. I'm not going to try to predict. But again, all elections have some type of impact on the future, whether it's in the UK, whether it's Japan, whether it's here. And I think it's something people need to pay attention to and think about it longer term rather than short term reaction.
You know, Elizabeth, you mentioned gold, and it's amazing. Obviously, we had a pretty big sell off in all risk assets on August 5th. Gold was not spared, by the way. But since then, you know, it continues to be lower left, upper right for a myriad of different reasons. But you just said it before when we started this Japanese conversation, all roads lead to gold. And again, dollar goes up, dollar goes down, yields up, yields down, seemingly doesn't matter. Gold continues to go higher. So, what do you think, if anything, derails this? Because obviously, there's always that you have to look when you're in a position, when you're in a trade. The most important thing to do is, you know, how can I be wrong? And I've searched for reasons as to how one could be wrong in terms of the gold bull thesis, but I'm hard pressed to figure it out. Thoughts on that?
Well, first of all, I don't think it's being driven by a lot of the normal things that you would expect. So, dollar moves, I don't think it's being driven by that. And we talked about this a few weeks ago. It's still the case. It's central banks, a lot of China buying gold, a lot of institutions buying gold. So, number one, how can we be wrong if we wait too long? If we stay in the trade too long when it gets long in the tooth? How do you know when that's the case? When retail starts plowing into gold. And that has not happened yet. If you look at just the flows into the ETFs, how retail can actually access the gold market, they have fallen as gold prices have risen. Now it's become a bigger part of the conversation, but it's still very talked about, not positioned in. And I think we would need to see a positioning come in. Other than that, how does it go away? I think if central banks suddenly get their junk together and if politicians suddenly get their junk together, I do not expect that to happen anytime soon. And this currency volatility, both in Japan, in China, basically in Asia in general, would have to really calm down. And again, I don't see that happening anytime soon.
Danny, we got jobless claims on Thursday. I think the expected number is 235,000. On Friday, we have the last job report before the election. The market is looking for a 4.1% rate of unemployment. I would suggest that this will be the low we see for the foreseeable future as we get through the election. And I think this thing is going to start to stair step higher. To me, that's been one of the things I've been concerned about, by the way, another concern that's been unfounded. But the importance of the labor market in this entire sort of pastiche or what mosaic that we've been weaving for the last half hour.
Well, let me make a comment on gold if I could, and just echo Liz's sentiment and comments on it. Every type of small sell-off, we were getting 8 to 10% sell-offs potentially a year ago in gold when the macro would go against it. Now we get 1 to 2% type sell-offs, and every dip has been a buying opportunity. And I'm watching Bitcoin, which has recently been outperforming kind of gold here. And I want to make one note that Emory University, not that I agree with it, my alma mater, is now their endowment has been buying the Bitcoin ETF. Very large purchase for them, actually. And so I say that on Liz's comment about retail owning gold, it's not there yet. Bitcoin somehow is now making its way into the endowments, and I don't think they're in gold either, Liz. I just want to add that. So Bitcoin continues to steal a little bit of gold thunder. As it relates to the job market, it's the be-all, end-all as it relates to what the Fed has been pointing to, and they're looking at labor versus anything else. They're willing to risk reinflating or a little bit of an inflation to, quote, soft land or no land this economy. So it is very important. Again, it's not important this week at all. It'll be important after the election, I think, going forward. And so whether people trust the numbers, whether what it's going to look like, Guy, I totally agree with you that the unemployment rate itself is probably not going back below 4%. I don't believe. Could be wrong, but I think it has one direction to go. And so if that's the case, we know if everybody's in place still in their positions 6 months from now, that the Fed is going to be signaling cutting rates if the employment picture worsens at all. And I think that's what people are watching. So people are fine with 4.2%, 4.3%, and maybe even 4.4% unemployment because they know that the Fed will have their back for a period of time. Again, that's a positive for gold. Back to Liz's comment for sure. So
EYT, before we 5,000, anything that you're looking at this week, what be it single stock in terms of what it means for the broader market or economic data that's coming out?
Well, look, one of the things, this is another set of data that I'll ask myself in 6 months, should we have paid more attention? Guy, you and I have talked about this a number of times. Even if the labor market doesn't get a lot of headlines this week because there's so much other stuff to talk about, the fact that Boeing has done a big layoff in the last couple of weeks, we heard about Volkswagen doing some reduction in force. when you get companies in the industrial sector, some of those bellwether manufacturing names, even though our economy is not as dependent on manufacturing anymore, you do have to perk your ears up. So if that trend continues, if we start to hear from the likes of other big industrials about layoffs and so on and so forth, and the manufacturing sector really suffering, I think that's something to pay attention to. And I would agree with Danny. I think the unemployment rate at 4.1% still very healthy, but is it going to go back down to 3.6, 3.4? No, I don't think it's going to go back down there. And if it were, we'd see it in jolts first. You'd see job openings increase, and then we would have to see the unemployment rate fall after that. And I just don't think that that's going to be the trend. But right now, I think everybody is absolutely hell bent on hanging on to this strong economy narrative. And it would be tough to throw us off of that with just a little tick here and there of 0.1% in a certain data point.
I know Claudia Sam is watching. Danny, last word to you.
I've been thinking about the time period of kind of 2006, 7, and 8 and trading in that environment and literally seeing the end of the financial world, or maybe the end of the world happening in real time. And it's hard to unsee that. And I've watched over the last 15 or 16 years, all the government intervention, the reliance on global central banks and all the things that have occurred. And all we did was transfer the risk from the corporate balance sheets to the public balance sheet. And at some point that's going to matter. So I can't unsee what we all saw. And I saw up close and personal in kind of 2007 and 8, and call me jaded, call whatever it will, but that's how I kind of have looked at things. In a period of time, can you ignore it? Sure. Can we ignore all the stuff that's going on in this world right now? Maybe. But the geopolitical risk and the financial risks that are still in the system, I think are being underappreciated in the markets. Maybe we'll get some type of clarity over the next week or so, but I don't expect that. So I expect a lot of volatility, a lot of stock picking that's going to matter. Again, when the market has these big sell-offs, especially in the Russell, a lot of small cap companies get thrown out. Those are the ones you want to look at and buy. And so I think there's opportunities again on both sides. So
Lots to unravel here. I'll say this. Elizabeth mentioned 4.25, 4.30, and the 10-year yield being sort of a level. I agree with that. We'll see. But what Danny just talked about, and I agree with you wholeheartedly, is one of the reasons I still think yields go higher. And obviously, if I'm right, they're going higher for the wrong reason. So we'll see how that whole thing plays out. But EYT, always great seeing you. Danny Moses, a joy and an honor and a privilege to have you.